Okay, good morning. How are you guys? So this is topic 4 on share-based payments. This will be covered in your major quiz next week, right? And this is actually quite a challenging topic because it's about whether we will need to account for something that has happened, but conditions may or may not satisfy in the future. Last topic, we went through concepts of vesting. Okay, what does vesting mean? Meaning unconditionally that the company will have the obligation. Okay, and we also went through in accounting whether vesting happens or not happen. It has nothing to do whether the company will need to account for these activities or these transactions, yeah? It's only in the end if the employee has not satisfied the vesting conditions, then the employee is not going to receive the benefits, full stop, okay? At that point, the organization may reverse some of the accumulated recognitions, or they may simply just let the accumulations carry forward, okay? So that concept we looked at a couple of days ago about vesting. It's very important in share-based payments. The idea here is before AASB 2, a lot of organizations saying, okay, yes, we do have some performance conditions, but we do not know whether the employee is going to satisfy those conditions. Therefore, we're not going to recognize them. Okay, we're going to recognize them when they satisfy the conditions, and we'll give them a cash payout. Now, two problems with this statement. First is you will be understating the expenditures before the vesting conditions have been met. That's number one. Number two, some of these cash payouts are huge, okay? So if the company waits to recognize these conditions, and when the cash payment is made to the employees, then there will be a cash shortage for the company. Okay, before we go any further, let's just have a look at this, a file under Moodle, okay? Called the ACCI CEO pay. So ACCI has done a survey, has done this research study just to look at the CEO payments, the top ASX 50, top ASX 100 CEO payments. Have a look at this page 28. Okay, now the cash bonus, or the cash payment to those CEOs are already very significant. Okay, let's just look at the CEO of CSL. Okay, so the cash pay is 6 million. But look at the most right-hand side column. Value of the equity holding is 10.2 million. Okay, that's a lot of money for any company, even for top ASX 100 companies. So if Paul Perrault is going to say, I'm going to exercise my options now, and the company will need to pay him $10.2 million cash at that point in time. So does that mean this $10.2 million only be recognized at the time Peter exercised his options? No. Okay, so AASB 2 puts a stop to it. It's saying this $10.2 million needs to be recognized from day one. The company has committed to Peter. Okay, the company has signed a contract with Peter saying if you met these conditions, we were going to reward you with this. Okay, however, whether Peter is going to be meeting these conditions has nothing to do whether the company needs to recognize it from day one. We looked at it a couple of days ago, right? Vesting meaning you need to start from day one. Okay, the problem here is if Peter does not satisfy these conditions, the company can reverse, okay, those expenditures, okay? Unlike annual leave, and annual leave 100% vesting, so you can't reverse, right? So therefore, today we're going to, look at some of these recognitions, and we'll look at particularly the contract conditions, how, as accountant, account for these transactions, okay, according to the mandatory requirement of AASB 2. So what do you need to know for this topic? We always start from the learning objectives. What is objective AASB 2? Simply, it's about how do we account for share-based payments. Now, going back to the positive accounting theory. Positive accounting theory predicts people are self-interested, okay? But you can't run a business without the insiders, and you can't run a business without outsiders' capitals. Okay, so the share-based payments is about the capital provider saying, okay, if you run the business very successfully, then I am willing to share some of my success with you. Okay, this is about what? Bonding mechanism. So PAT has a number of accounting hurdles in aligning the insider and outsider interests together. First is monitoring, right? We have accounting hurdles. We also have like auditors, and then you have the bonding mechanisms. Here is the bonding mechanisms, okay? But the bonding mechanisms also have accounting hurdles inside, meaning, okay, you need to achieve return to equity, or you need to achieve accounting earnings by how much. That's why accounting is so powerful here. Then we look at the difference between cash settled and equity settled share-based payments. Now, the accounting for these two is so different. Why? Because under the equity settle, it means you will settle with your shares. However, under the cash settle, means you will settle the transaction with cash, but the measurement of cash is in reference to the equity price. Okay, now let's look at the equity settled first. If it's equity settled, what will you give in the end? Shares, okay, you will give equity, so you credit shares, right? Now, what about the cash settle? You pay cash, correct. Very good. So you pay cash, but the amount of cash is in measurement to the equity value at the point in time that you agree to. So therefore, these guys give rise equity, gives rise shares. These guys give what? Liabilities. So they're very different in accounting, okay? And then we look at how equity settled and cash settled transactions are recognized. Well, one is, this is liability, another one is equity. In addition to that, the measurements are very different. I will explain why as we go through. And you need to explain how equity settled share-based payments are measured, okay? And the concept of vesting through differentiating between vesting and non-vesting conditions. We've gone through this a lot a couple of weeks ago in the last topic. We're going to go through that again today. And then we explain how modifications to granted equity instruments are treated. Sometimes you sign a contract, okay? However, over the years before the contract matures, things change, okay? So when significant events change, then they may renegotiate, and when they renegotiate, that may result in some of the conditions have been changed. So we will look at, well, when those conditions change, do we need to account for them? If we do, how do we account for them? Okay. Then lastly, we look at how cash settled share-based payment transactions are measured. So these guys measured in reference to equity, right? As I said here. But it's about what equity, at what point we measure. So the measurement of cash settled and equity settled share-based payment are also very different. So the recognitions are different and the measurements are different. Okay. So what it is refers to a transaction with which entities settles another party to receive either a cash payment, that's a reference to the amount paid dependent on the price of the entity's shares, or other equity instruments such as ordinary shares or share options in exchange for the provision of goods or services. So yes, firms can pay their equity for goods, not just services. Okay? Firms can pay their shares to their employees, but also can pay their shares to external providers if they have an agreement. Okay? So again, we look at what is the measurement to external providers and what is the measurement to employees. Okay? That depends on whether the fair value is valid for these different groups of people or the services that company received. And soon you will see there's no fair value for employee services. Okay? There is fair value for goods and services received from external providers. And therefore, that's a reason the measurements, whether it's you're settling with insiders, which is employees, or you're settling with outsiders, external providers, are also very different. Okay, so I'm throwing a lot of things on you at the moment. Are you catching up? So this topic is very challenging because the recognitions are different and measurements are very complicated, okay? And complicated in terms of not mathematical calculations, which we go through them quite a bit today, but also because of we really need to look carefully what the transaction parties are in these equity settled transactions. Okay, they're increasingly common as a form of remuneration for senior management, but also from any other employees. Well, people will say, why do you reward employees' share options, equities, okay? Well, for top management, that makes sense because they make the major business investment decisions, okay? And therefore, they need to be very careful. Their investment decisions are going to generate firm value. If firm value goes up, the equity value will go up, and therefore their own wealth also will go up. But what about bottom-level employees, entry-level employees? Okay, is it worth rewarding them with the share-based payments? The answer is positive. Why? Also, it's about encouraging employer retention. So most of the large companies, for entry-level employees, the very simple condition is if you stay with our company for a number of years, by then you will receive these shares. Okay? Why? Because employee turnover costs the company a lot. You need to retrain the employees, you need to restart the recruitment process. So if you give them some shares just to entice them to stay longer with the company, be loyal to the company, and that also will save a lot of resources the company needs to incur to retrain the employees, to recruit new employees. Okay, that's why we look at different level employees. Sometimes the conditions are very different attached to the share-based payments. And in that case, when the conditions are different, again, our measurements are very different, okay? So when WASB 2 specifically says, okay, when share-based payments are used to remunerate employees for their services rendered, they are employee expenses. So we know if you give out shares, you credit equity. The problem here, the concern here, what do you debit? Okay? WASB 2 makes it very clear. If it's paid to the employees for the services they rendered, then the debit will be an expense. But if you pay for the goods you received from an external party, yes, that goods can be an asset. So what the debit was a big argument in the past before WASB 2. Okay, they said, well, we have this equity increase, and what do we recognize on the debit side? Depends on what you pay for. You pay for employees for the services, yes, there is employee expense. But you pay for a goods or services from an external party, depends on if that good has a fair value, then yes, it's an asset. Okay, and if the services also have a fair value, and that service is measured at fair value as an expense. Okay? So to sum up, right, the three forms of share-based payments, these guys, equity settled, receive goods or services as consideration for equity instruments. Cash settled, they acquire goods or services by incurring liabilities to the supplier for amounts based on the value of the entity shares or other equity instruments. So, loud and clear, if they settle in cash, then they are liabilities. But if they settle in equity, by you giving out or increase the share, then this is an equity, okay, credit shares. And there are other forms of SBP, which is the mix. At that time, you can settle with equity, but other time you can settle with cash. So it's not covered in this course, but if firms give out these mixed types of share-based payments, again, there are more professional judgments involved, okay, in terms of how likely that the cash settlement condition is going to occur. And then we need to put a probability on that, and that part, the portion of the probability will be recognized as liability, the other portion will be recognized as equity, okay? So there are a lot more professional judgment involved if there's a mixed type of share-based payments. Okay, all we're talking about here is before the payments are settled. When the payments are settled, that's easy. We just like account for the value of the instruments or account for the value of the cash we pay out. The critical part of AASB 2 says you can't wait till the time you settle to account for these transactions. You need to account for them as they occurred. Why? If you want an employee stay with a company for 5 years, do you not recognize the first years of this employee's service? No, you can't. You still need to, okay? Because the employee has worked for the company, and the employee has worked for the company under the understanding that if I put extra effort into it, I will get this amount of the bonus. Therefore, this kind of the intangible effort must be recognized over time, okay? Over the time of vesting period. Make sense? Just like last topic, when we look at long service leave, we recognize long service leave over time, right? Same as SBP. We measure and recognize SBP over time. At the final point, then we decide, do we give this out or do we reverse because the vesting conditions have not been satisfied? Now, very simple recognition. You have debit asset, expense, credit equity, or debit asset, expense, credit liability. This is very easy, but it's the measurement that's going to be a little bit more challenging, okay, for SBP, because we need to really think loud and clear how likely this is going to occur and how are we going to recognize these expenses or assets over time. Now remember, the last topic when we look at employee benefits, we said some of the employee benefits can be recognized as assets. For example, an inventory called by the commercial principle, direct labors can be capitalized as inventory, and the direct labors incur in storing operational machine that can also be capitalized as PPE. Likewise, development expenditure paid to research and development employees that can be capitalized as 138 asset. Yeah? So this is similar here, SPP. If you can directly establish those employee benefits are directly contributing to creating the asset like inventory or intangible asset or PPE, then yes, that SBP can be recognized as assets. That's particularly prevalent in these days in intangible assets, okay? In these high-tech firms. Now, how do we measure? Okay? We know the recognition now. How do we measure? We recognize share-based payment transactions. Okay? These are the equity settled transactions. The measurement basis depends on whether the transaction is with an employee or a non-employee. What the standard says is, well, if you settle in with the employee, there's no fair value for the employee services. So how do we measure? We measure using the fair value of the equity instruments granted. Okay. At what point do we measure this? At grant date. Okay. And when does the recognition start? Day services received. Again, similar to long service leave. Day one, the employee starts working. Then we need to start measuring and recognizing. Okay. So for employees, the measurement is the fair value of the equity instrument granted at grant date. Now, the fair value of the, particularly the share options, will go up or down, okay, in the future, but doesn't matter. You measure it at grant date, okay, using the grant date measurement. Now, for non-employees or external providers, there is a fair value. So the standard setters believe there must be a fair value. If there's no fair value, maybe it's a non-arm's transaction, okay, it shouldn't be happening in the first place. So it's very, very uncommon that for non-employee transactions, there is no fair value. Nevertheless, if they don't, same as the measurement, same as the employee. But if it is fair value for the goods and services received from external parties, then it's the fair value of the goods or services received. Okay? Similarly, the measurement starts from the day that the firm receives these goods and services. Okay? Let's have a look. Some of the examples, what do these concepts mean? So this transaction is settled with a what? External party. Okay? Now the external party has provided the entity with something, has a fair value of $2 million. And in return they say, I want your shares, I don't want cash. Give me the shares you have. So therefore the company will allot the supplier X with 2 million shares, 1 million shares. But this 1 million shares worth $2 million at the point. Okay? So they recognize a $2 million increase in inventory, also $2 million increase in share capital. Okay? So what does this mean? They actually make the suppliers part of the shareholders. Okay? Must be because these suppliers have a very strong bargaining power and they see the value of the company. Make sense? Okay. So the company will have a different share registry. Okay? They say, okay, this is on our balance sheet, but our share registry saying supplier X has 1 million shares. Okay? By the time for voting, for example, if the total shares out there is 2 million, so supplier X actually owns half of the company. Do you guys follow? Okay? Sure. No, number of shares 1 million. Share capital is still $2 million. Yeah.
But it's depend on the share price. In this situation, we don't know the share price.
They agreed. They agreed. At that point in time, they must look at, okay, what is the fair value of our shares? At this point in time, they probably think the fair value of the share is $2 per share. Okay, it's a good question. At the time, they probably value, the fair value of the shares is $2 per share. That's why they give them $1 million shares. And the value is $2 million. Okay? So if this is not a listed company, for a listed company it's easy. Okay? If it's not a listed company, the company between the company and the supplier will negotiate. Okay, how much is the fair value of your shares, and I want how many shares in your company. Okay, why? Why do they prefer equity over cash?
The share price of the company has the potential to increase.
Yes, because they expect there will be capital growth. There may be capital growth in the future, and also dividend distributions. Remember, dividend distributions is what? Perpetual, ongoing. Okay, your cash value will decrease, but dividend is going to be perpetual, ongoing in the future. So it's a very good cash flow, long-term cash flow. Okay, so in that example, the vesting condition is a very simple exchange of ownership of the inventory. Now, the vesting conditions for employees vary. Look at that. In the example above, that's granted without conditions because it's an arm's length exchange. But in most cases, share-based payments, especially with employees, normally subject to one or more conditions. These conditions determine when or whether the employee becomes entitled. Okay? And I have said it enough over the last week with you guys. Like, whether the employee is entitled doesn't mean that the firm no need to recognize, right? The firm needs to recognize whether the employee is entitled. They would decide at the end of the contract. Now, the different types of condition can affect the timing of recognition and the measurement. Okay? So this is very different. Whether we have a simple service condition as the vesting criteria, or do we have other performance criteria into the vesting conditions, that will affect the way we measure employee expenses and the equity condition and the equity values. Okay? So a vesting condition is defined as a condition that determines. So in the case of equity settled SPP, the meeting of vesting condition will result in the issue of shares or share options by the entity to the other party. Okay? So like the CEO poll we looked at, CSL, if he has satisfied the conditions, then he will be allotted with $10.2 million worth of the shares. And it's up to him whether he wants to hold on to the shares or whether he wants to sell off the shares. Now, a lot of examples, empirical examples in real life, a lot of CEOs, before their retirement, they will sell off all the shareholdings. Or if they smell something the firm is not going to go very well, they're going to sell off their shareholdings and resign. So whenever CEOs, the market watches these CEOs' decisions, activities very closely. If these CEOs are holding on to the shares, they think, okay, this is quite a stable company. But as soon as they see the CEOs dumping a lot of shares, that's something wrong with the company. Okay? And the market will react once the CEO is dumping a lot of the share holdings. What do you think? The share prices will go down. Okay? Now, what are these vesting conditions that particularly apply to employees? Okay? Does the condition require only a specified period of service to be completed? If yes, then it's service condition only. Recall earlier I said we also give entry-level employees bonuses, and the only condition is they stay with the company for a number of years. And if that's the case, that's a service condition only. That's fairly easy to measure, but there's a few things we need to watch out for. Now, move up to the ladder. We have now senior management, executives, CEOs. Not only they need to stay with the firm for a number of years, they also have performance conditions attached to it. Okay? So if there's a performance condition as well as a service condition, then we need to go further and ask, is the condition related to the market price of the entity's equity instruments? If it is, then we say the performance condition is market condition. If it's no, then it's a non-market condition. Again, why are we giving you this flow chart? Because the measurements is very different, okay, across the three bottom boxes. So that's why when we look at the transactions, and for you guys, when you look at the exam questions, you need to be very careful. You need to identify, are there any service conditions? Most of them, yes. But in addition to that, are there any performance conditions? And what is the nature of these performance conditions? Are they market-based or are they not market-based? Okay? Because they will affect your calculations. Let's first start with a very simple example. Service condition only. Okay, it requires the employee to remain employed for a certain period of the equity instruments to vest. So the condition is time, simple. But you stay there long enough, we don't care how you perform, you get the share at the end of that time. So these are accounted for by adjusting the number of equity instruments included in the measurement of the transaction amount. So we will do the adjustment. Okay, we're going to go through this exercise. How do we do the adjustments? This means if a vesting condition is not met, then the employee's right to receive the equity is forfeited and nothing will be recognized in the financial statements. Yes, you can go and reverse. If the employee leaves before the service period, then the employee, of course, doesn't get anything. And what about the employee expenses I have recognized previously? You can reverse those, okay? However, a lot of firms don't do that because it keeps snowballing, keeps accumulating, and then they will readjust every time. When they do the readjustment, that's actually forfeiting the expenses, okay? So how do we do the adjustments? So if the vesting period is, let's say, 3 years, okay? So the first year, we need to estimate, by the end of 3 years, how many the existing employees will stay. Very similar to the long service leave, okay? So where the service period extends beyond the reporting period, the entities are required to estimate the number of equity instruments expected to vest and calculate the expenses for that reporting period. Okay, so it's a 3-year service. You estimate how much is going to occur at the end of year 3, and for that amount, you need to amortize over the 3-year period. Does that make sense? Okay, similar to long service leave we did a couple of days ago. That's your ending liability. Okay, you amortize your ending liability over the service period. Okay. Now, where subsequent information indicates that the number of equity instruments expected to vest differ from previous estimates, then these estimates should be revised, and you must disclose through AASB 108 why your accounting policies are, why did you change your accounting policy? Meaning, why do you change your estimates? Okay? All right, now this starts going to be a little bit crazy, so you need to sit tight and listen carefully, all right? Because I want you guys to fully understand what the transactions mean. Now, the examples you see here will be tweaked very differently in your practice questions, and also will be tweaked very differently in your major quiz and your practice quiz. So what you need to do is just calm and read through the information carefully. That's all, okay? So this is a very simple service condition only. All right? Now, equity settle share-based payments with service period only as the vesting condition. Look at what the contract says. The company grants 100 options to each of its 50 employees on the first date. The condition is only that the employee must be staying with the company for 3 years. The fair value of each option at grant date is $25. And that's our measurement basis. Remember, for under employee, that's the fair value of the equity instruments at grant date. Okay? In this case, it's 25. Okay? This will stay as 25 unless there's a modification. Okay? So we look at modification example as well today. But this will stay regardless what year you are recognizing. A-Limited estimate that 10% of the employees will leave during the vesting period. Now, this is just only what the company is budgeting. It's budgeting, okay, there will be 45 people remain with the company at the end of year 3. So I'm budgeting for 100 times 45 times 25. That's my budget. But these estimates will change very quickly. Okay? As I said, we can't hold employees with the company. Right, let's have a look at what happened during the 3-year period. So at the end of first year, 3 people left. So these 3 people are no longer entitled, right, to these share-based payments. But what the company forecast was total departures will be 8. So at this point in time, they think there will be 42 people remain with the company. Is that clear? Yeah? 42 people will remain with the company. Then the total equity going to arise will be 42 times 100 times 25. But this is only the first year of the 3-year period. Then I will need to amortize 1/3. You guys follow? All right. In the second year, 2 people left. They readjust their forecast. So they think in total 6 people will leave. Total forecast departures, okay? I highlighted total. I explained why. 6 people, in total 6 people will leave. So in this case, 44 people will remain. Does it make sense? So 44 people will remain. So we owe these 44 people 100 options, and each option is worth $25. That's at the end of year 2. So that total liability will be amortized over 2/3 because this is the second year, okay, out of the 3-year period. All right. In year 3, this is the end of the transaction. So how many people left? 6 people left. 44 people will remain. So the company owes these 44 people 100 options each at $25. Okay? And that is the total liability. Now, don't forget, you recognize these equity transactions a couple years before. So you need to subtract what have you recognized previously. Just like the long service leave, we are recognizing an ending result. This is the ending accumulated value of equity instruments. Okay. Now, before I go to the calculations, I just need to warn you about these. When you look at some of the questions in your quizzes or in your textbook practice questions, when we say this is additional departure, then your calculations will be different. What if I change this to additional departure? This will be 11, right? And then your calculation would be 39. Do you guys follow? If I change this to additional departure, that means they think in total 11 people will leave, therefore only 39 people will remain. But in this case, we say total departure. That means this 8 has already included the 3. Okay? All right, let's have a look at the first year. As I went through with you just then, 100 options each, we expect in total 8 people will leave, therefore only 42 people will remain. And the fair value at grant date is $25, and it's a 3-year service period. This is only the first of the 3 years. So therefore, first year we will recognize 35,000 employee expenses as well as equity value that will generate by these employees. Okay? You guys all right? You understand why over 3, yeah? Because this is the first year of the 3-year period. That's exactly as SBP said, you can't not recognize before the before the employees satisfy the conditions. You must recognize that, okay? Over your reporting periods. You can't wait until all these become crystallized, then recognize in one go. No. Of course, that's the manipulation. Some of the firms want to, oh, I have this contract, we're not going to recognize now, we'll recognize in 3 years' time. 3 years' time, boom, you have a very big expenses on your income statement, and the profit will go down. By the time the CEO will resign, by the time the CEO dump all the shares and resign, okay? And that's the reason that some of the opportunistic behaviors that AASB2 tries to prevent. All right, now look at this $35,000, okay? We need to make the adjustment in year 2. In year 2, we revise the estimate. Of course, this estimate revision must be disclosed in AASB 108. Why did you change the estimate? Okay, then you have 6 people in total will leave the company. The 44 people will remain. And we owe 100 shares to each of these 44 people, and the shares worth $25 at grant date. And this is the second year of the 3-year period. Now, we recognize 35,000 in year 1. Therefore, the current recognition is 38,333. So are we okay with this so far? Okay, in year 3, do we need to estimate? No, because that's the end of the service period. That's the end of the transaction. So we know the actual number of employees left are 6. So only 44 original employees remained. And for these 44 people, we owe them this much money. Okay, but we recognize 35 in year 1, we recognize 38,000 in year 2. Therefore, the current recognition is 37,000. Okay? Have a look at the impact. Okay. Sure.
So for top-line transactions, so if there's not a share option active, so if we pay by cash, so we just CR the liabilities here.
Correct. But, yeah.
So it's just liability, not the subsidy name.
Just liabilities, correct, yeah. It's just the measurements are a little bit different. We will go through that, those examples too. Okay. Okay, look at the impact. So this is $110,000 in total that will cost the company, okay, if the 44 people remained. So instead of recognizing $110,000 in year 3, the standard says you need to amortize these 110,000 over the service period, over the vesting conditions period. Make sense? Okay. Now, you say, oh, 110,000 is not a lot of money. Well, look at Peter, 10 million. If you have 10 Peters in CSL, that's how many? $1 billion. Okay. If you recognize $1 billion in year 3, your earnings is going to go into negative. All right. So that's the very basic share-based payments. In this example, the only condition is what? Service. You only need to stay with the company. Okay. All right, let's take a 10 minutes break from here before we go on to something more challenging. Now, not only you have the service period, you also have the performance conditions. Question 3?
Yes.
At first, you can ignore this 2% wage rise,
yes.
right?
Yes.
You have ignored it?
Yes, because they already gave the at the time of the
Exactly.
Yeah.
So the leaf loading is 15%, 1 point,
15%, yeah.
that's already the time of 1.15. Can I use your?
I think it's not relevant to non-stop, right?
No,
Because they just talk about
penny, yeah.
gain.
Okay, so she had 19 days
Yeah.
previously,
Correct.
plus 20 days she accumulated this year, and she took 20 days. 19 days legal. So 19 over 260. It's not right?
Let me calculate again if you think
Hey.
this one
19 divided by 260.
plus the
I need to look at it again.
you help me check that?
So
8930. Loading 1.15.
that's what she.
You think it's less?
Try. Oh no, she doesn't.
Delete.
I need to look at it. I need to look at it in the algorithm. What's wrong? I don't believe there's something wrong with it. I come across this question many times. There's something in the question that we have missed. Yeah.
Okay, we talk about it after class?
Yeah, sure.
Yeah, okay. Thank you.
This week. Yeah. Hi.
Question, why will you use an expected number or
Expected. Yeah. Because it's total departure. Expected. Yeah.
and not the actual number?
You only look at actual at the end of the vesting period. So Yashan, what's your name?
Sure.
Okay. So is it Yumin here? Yumin? I'll just wait for her to come. She said she will come.
Could you please give me her email?
I will.
address?
I will. Yeah. If she doesn't come today, I will give you. Yeah, pay you tomorrow.
So I also tried the ESG quiz for 7 times, but still some wrong question. It's no answer from here. I think it's only very question, and if I can see the answer, just remember it. If I take a question wrong, I don't know which one is the right answer.
Can you choose then?
No right answer. Yes, I can review it. And if I finish the quiz, I can only know which one I wrong. But I
Yeah.
can know which one is the right
But
answer.
that's the reason you need to go back to have a look at the textbook and then try it again.
You mean, I think some questions we haven't mentioned in class.
But
But it's
in textbook, yes.
Give me some guide which topic is relevant to ESG.
That's good.
Which one is relevant BSc?
Chapter 32.
32. This one.
Yeah, you need to read the.
Also, I need to read all of it.
Yeah.
Then I will do the quiz.
Yeah.
Okay, okay.
It's
Thank you so
mandatory
much.
reading. All the textbook chapters are mandatory readings.
Okay, maybe I just go through this. I will read it calculate.
Yeah,
Thank you.
yeah. Okay. So the service condition was a simple example. Here we will add on to it. Okay, we add on to, right, in addition to meeting a service condition, what about there's a performance condition? This is very common for senior managements, CEOs, or anyone has a decision-making power authority within the company. And before we jump into that, we first need to identify the nature of the performance condition. Is it this a non-market or market, right? Now, what do we mean by non-market and market performance conditions? Okay. So for the non-market conditions, they are normally based on accounting hurdles. So typical accounting hurdles will be EBITDA, like earnings before interest and tax, that's accounting number, accounting earning, or earnings per share. Again, earnings per share, the earning is an accounting earning, right? Or the entity needs to achieve a specified non-financial performance target, for example, specified market share, or in these days, very common, they actually have ESG matrix in CEO's bonus compensation these days, right? So those examples fall under the non-market condition, and these are not reflected in grant day fair value. What do we mean by grant day fair value? Is the share options, okay? Now, let me take a step back. You guys know what a share option is, don't you? Okay, a share option is, okay, currently if the share price is $5 and we give you an exercise price of $2, then you gain $3 if you exercise. That's a share option. Now, the exercise price is not the fair value of the share option. Why? Because share prices will change, will go up and down in the future. Okay, so let me just give you guys an example how share option works. Okay, so currently the share price is $5. Then the exercise price is 2. Okay, but you can't exercise just yet. You need to exercise in 3 years' time. Okay. This states $2. But how do we know what is share price in year 3 going to be? We do not know. So the fair value of the option can be greater than 3, can be lower than 3. Okay? So if this is a very strong growth company, in 3 years' time, the predicted share price is $50. Can you see? The value is greater than 3. If that happens, and that executive exercise the share options, he or she will get a $48 net gain. But what about in 3 years' time, this is going to be $1? Then this option is worth nothing. Okay? So every time a firm issues share options, which I'll show you some of the examples, like the Deloitte report, okay? Is the measurement of the fair value options is actually increasingly subject to auditors' criticism. A lot of firms do not value the share options accordingly. The most common use method is the black shoe model, or you can have the Monte Carlo simulation model. We want to know this financial instrument, how much is worth now. How do we calculate it? The black shoe model or the Monte Carlo simulation, we will plot all the probabilities. Now, probabilities at the end of year 1, how much is the share price going to be, plus many other factors involved. Okay? And with that, they determine this what this instrument is worth. Okay? This instrument may worth $40 if they're a very strong growth firm. This instrument may worth only like $2 or even $1 if this is a very low growth firm. Okay? And that's what we mean here. If it's a market condition, then the value of the share options is already reflects the future probabilities, the future share price, okay, and the future net gain. That's what it means here. So if it's a market condition, this means the share price of the company, okay, we already looked at, it's very common, like $10.9 million. There's equity holding of CSL, Peter, okay. And also the share price needs to increase by how much, or total shareholder return needs to be to meet a specified percentage increases over a specified period. Anyway, so any of these percentage, any of these ratios, or any of these targets involve the future share prices, then we call it as a market condition. Now, Deloitte is a firm that actually helps companies to value the share options, okay? They are a specialized firm that actually very unique. They have the unique skills to help companies to determine the fair value of the share options, okay? Now, why is it so important? Because the measurements are different. If it's market-based or non-market-based, when we measure the share-based payments, we measure them differently, okay? Let's have a look at a non-market condition first. So in this example, these people, not only they need to satisfy a 3-year period service, but they also need to satisfy performance hurdles. What are these performance hurdles? Okay, earnings. So these earnings are what? Accounting earnings. Therefore, they are non-market conditions. They are accounting numbers. Okay. Now, I need you guys really wake up and follow me, because understanding what is going on here will affect how we measure and affect how we account for these transactions. One of the conditions is that, okay, you guys, you 50 people, I give you 3-year time to have 3 goes at cracking your performance hurdle. So if in the first year you manage to increase our accounting earnings by 18%, you will receive these SBP payments. So if they actually did, what will happen? They will recognize in year 1 full stop. No need to look further. Does it make sense? Okay? So over the next 3 years, they have 3 goals at cracking these performance hurdles. If the first year they increase their earnings by 18%, they will vest, and no need to look further. Now, you understand why companies manipulate their earnings, right? If you have performance hurdles like that based on accounting earnings, of course, they're going to manipulate accounting earnings in order to get their bonuses. But if you fail that, okay, then in the second year, if you can increase your earnings on average by 13%, then again, the condition vests. We no need to look further, okay? But you fail that, again, in year 3, you have 1 more go. If you can increase average earnings across 3 years by 10%, then you will get your bonus. What if they fail? They don't get their bonus. The contract stops, okay? They may need to restart another contract again. Or maybe fire these people. You guys have 3 goals, you still haven't done it. You haven't been able to achieve your performance targets. You guys should go. So that's what the contract is saying, okay? Now, in our measurement, how do we do that? Not only we need to adjust our estimates about the people who will stay, okay? Second, we need to look at the probabilities that the earnings target will be met in 3 years' time. So 2 things now. You need to adjust the estimates about people who will remain. Second, you need to look at the probabilities, how likely the earning targets will be achieved. So how do we do that? First, we look at the actual earnings, 12%. Have they failed? They failed, yeah? So first year, they're not going to get their bonus. Now, actually, employee departed, 3. Anticipate depart during the second year will be 3. So in total, they estimate 6 people will leave the company. Now, only 44 people will remain at the end of year 2. Do you follow so far? So at this point, they estimate in total 6 people will leave the company. So at the end of year 2, only 44 people will remain. So what it means here is we're at this point, year 1, at the end of year 1. They need to estimate what's going to happen at the end of year 2. Because year 1 failed. If year 1 is successful, they don't even need to look at that. Okay? Now, anticipate next year's earning 16%. What was the hurdle again? 13%. So the actual earning this year is 12. They anticipate 16% increase. Across the 2 years, what's the average? 14. Are you guys following me? 14. Will they meet the hurdle next year? they will meet the hurdle. Yeah? So at this point in time, they estimate, the company estimates, based on the two hurdles, two probabilities, number of employees as well as the earnings. They estimate that will vest. The contract will finish at the end of year 2. That's what they estimate. Okay? So what is the total vesting period then? At this point in time, they estimate the total vesting period is 2. Okay? Make sense? Any questions? They don't need to estimate, just pay. We'll talk about that later. Yeah. Simply, the employees don't exercise the options. Okay? All right. So that's what is going on at the moment. So how do we calculate? The first part is the same. We anticipate 44 people will remain. Each one will earn 100 shares, and each share at fair value, the fair value at grant day is 20. And this is only the first year of the 2-year vesting period. Do we understand this? Why it's over 1/2? Because at this point they estimate the vesting period is going to be 2 only. All right? All right, as time goes on, now we have actual number comes through. So the actual earning is only 10% this year. 10 plus 12 is 22. Average is 11. What was the target? 13. So they fail again. This time, see, I use a solid line, meaning this already happened. They need to look at what is going to happen in year 3, because the contract period is 3 years, right? They said for 3 years, you'll have 3 goals. So at the end of year 2, again, they need to make estimates. What are the 2 estimates? People that will remain, that's one estimate as usual. Second, how likely they will hit the target, meaning what is next year's earnings, right? And at this point, they estimate next year's earnings is 9%. So 12 plus 10 plus 9, average across the 3 is just above 10%, which is the performance hurdle, okay? At the end of year 3, they need to achieve 10% average over 3 years. Now, what is the vesting period? They have to extend the vesting period from 2 to 3. Okay? Make sense? And that's why when we do the calculations, can you see here? It's 2/3 rather than 1/2. Don't forget to adjust the previous estimates recognized in year 1. So I'll just stop here for a second. Does everyone, I hope everyone understands why this is 2/3 rather than 2/2. You understand why they extend the performance vesting period? Okay, good. Sure. Which part? Yeah, at this point they estimate that's actual year 1, 3. In year 2, they estimate 3 people will. Now they calculate at the end of year 2, what is my payment at the end of year 2?
He says year 1, 30 June, end of 2020. So that's at end of 24, it means 23 was leave, but the other one, the other three is leave at 25.
Yeah,
So it's not actually leave.
that's correct.
Yeah, so why when we calculate year 1 we have minus 6 in total?
Okay, so only the people still stay with the company at this point
Yeah.
will get the entitlement. So if they estimate these 3 people will leave before that date, then these
But
3
it's not leave in year 1, right?
correct, correct.
So why we minus that 3?
But we are calculating what is happening in year 2.
But it's calculating at the 30 June means the previous year's financial year. It's not after. Because it's just end of 24. It's not end of 20.
Correct.
End of 24 is only 3 people left.
That's right.
End of 25 is only 6 people left.
Yes.
So as the year 1 is just 24, it's only 3 people left. So we cannot. I don't think we can calculate 3
Well, these people left, they're no longer entitled, right?
Yeah.
These 3 people may leave, they also may not be entitled.
Yeah, may or may not.
Correct.
So, but this is just for the second year, it's not for the first year, right?
Correct.
So you go to your first year calculation. It means that you minus the 3 for the second year.
The first part, without the 1/2, the first part is calculating how much I owe to the employees at the end of second year.
But why?
Why is,
But no, I just confused about because of the year 1, right?
yeah,
So it can only calculate. It's not for the. I think your calculation step is for the whole 2 years and but can calculate the average, right?
Yep.
But what I think is just calculate as the previous one, just one by one. Year 1 is minus 3 and do that. It's not the whole 2 years.
but even though it's year 1, the people remain in the year 1, they still haven't got the bonus yet. They still haven't because they haven't achieved the targets.
Yeah.
So that's why they need to look further. Yeah, we are estimating the future. You're right. This is not the final numbers. We're estimating the future. It's only the numbers we'll finalize in year 3. So you look at, in year 3, we look at the actual numbers, no longer the estimates. Okay? Okay, now what happens in year 3? They have to achieve the target, yes, right. And the 3 people left in year 3, again, they were not entitled to the benefits. So at this point, we are looking at the actual departures. So in year 3 is 3, in year 2 was 2, in year 1 is 3. So that's 8 people left, only 42 people remain. And now at this point, we look at what happened here. The actual numbers, 42. So it's 3/3. Okay, this is the final year. So the first part of this equation calculates, at this point in time, in total, how much I owe the employees, right? And we have already recognized some of that in the previous 2 years. So this year, we only recognize $27,000. Now, let's put these things together. The whole scheme cost the company $84,000. This $84,000 amortized over 3 years, First year is 44, second is 13, last year is 27. Okay, what happened in the first 2 years? Not only we need to estimate the number of people who will stay with the company, we also need to estimate whether the earnings are going to be achieved. Okay? So I'll just leave it here for maybe a minute or so, just let you guys digest it, go through it, see whether you understand it thoroughly.
Is it a problem that the first year is based on 2 years calculation and the rest 2 years is based on 3 years?
Yes, yes.
It's a problem.
It's not a problem, it's just to account for the nature of the transaction. That's what we do as accountants. We need to only estimate.
But it's not actual. But I just wonder if it's an actual one. If it's, we don't estimate, it's actually happened. So when we calculate the first year based on 2 years and the rest 2 years based on 3 years, this may be a problem, right?
Why it would be a problem? What's the problem?
No, I mean, because the first year is based on 2 years, right?
Yes.
Based on 2 years period,
Yeah.
so you just calculate the average.
Yes.
But the rest 2 years, you call in 3 years. It's not average, it's the specific. 1 year happening, 1 year happening.
Yeah.
So maybe the first year will be a problem because it's just calculate the average, it's not specific. Year 1, the actual number.
Yeah, correct.
Maybe
Yeah.
year 1 will be a problem because it's just based on average, not on actual.
Yeah, you are very right. Yeah, it's a very intelligent question because firms can do the wrong estimates. They can deliberately.
Because I hear estimate is okay. It's okay, right? But for actual, maybe it's just a problem for year 1. That's the whole question I have.
Yeah. Okay. Yeah. But we're trying to look at the future, and then account for the past. That's what we do, unfortunately. Like long service leave, same thing. You're trying to estimate the future and then account for the past. Okay. Any other questions from other people? That's correct, yeah. Yeah. And cash too. You debit cash, right? So AASB 2 does not cover the exercise of the options. That's going to be covered in AASB 9, a topic later on you will learn financial instruments. Okay, now some of you already asked me about option exercising. These options have a number of years life, okay? It's not like, okay, you vest at that point, you must exercise. Not like that, okay? It's like you've satisfied the conditions and now we'll allot you with the share options. It's up to the individual employee whether they exercise the options or not. Of course, if the exercise price is lower than the share price, they will not, yeah? But what about if the share price is higher than the exercise price at the point of vesting? These employees may still hold on to it because they may see in the future share prices will go up even further. I'm going to bet on this and I wait for the capital gains, maximize, then I will exercise my options to maximize my capital gain. Does it make sense? Okay? Now, again, it's not the focus of this topic. In real life, we all care about what do we do with the share prices, with the share options, okay? And if you guys have studied some of the finance top subjects, share options have a life, okay? 5 years, 10 years, or 20 years. Now, actually, in these days, some of the executive compensations specify the CEOs cannot exercise their options until a certain day. Okay, why? You want to maximize the long-term interests of the shareholders, right? Rather than the short-term interests. So today, vested. Okay, so from here to 5 years' time, you can exercise the options anytime you want. Okay, what about after 5 years? You don't. You forgot. Then these options forfeit then you will turn them into, make adjustment through the equity account. Okay, so that is something we will go over a little bit more in the financial instruments topic AASB 9. But at the moment, we are AASB 2 concerned what happens before this point, before the vesting period concludes.
How do we write the entry when we calculate these three items?
Yeah, so employee expenses, shares, share equity or share options, okay? Employee expense, share equity. Employee expense, share equity. Okay, what if, over the years, we got a lot of questions from students. Students seem to more interested in what happens after rather than before. Like let me repeat, AASB 2 focus on before the vesting period concludes. A lot of students are very concerned about, oh, what if it doesn't satisfy? What if they satisfy? Hold on, what is going to happen? And that's why we wrote additional slides to answer those questions. What if they fail again? What if they fail at year 3? Okay? You don't recognize this expense. What about the 2 expenses you already recognized in the last 2 years? You can forfeit, meaning readjust in your retained earnings account. Okay? You can reverse the expenses. Make sense? Okay? I'll repeat one more time is, what if in year 3 they fail again? You no need to do this exercise. You no need to do this $27,000 recognition. What about these $57,000 recognition I already made in the past 2 years? You can go and reverse them through the retained earnings account. Yes?
So can we recognize the expense in the past 2 years as a provision for
No.
the condition meets in the 3rd years, so it's
No, definitely not. That's what AASB 2 says. It's definitely going to affect your P&L rather than your balance sheet. Yeah.
If we want to write the reverse entry, it's debit share capital, credit retained earnings.
Yeah. You can also reverse expense. Okay. You can debit earnings, credit expense, or credit reversal of expense.
Or credit, we can write reverse expense directly.
Yeah.
Or retained earnings.
Yeah. Again, that's not 5943. You don't need to worry about it. But if you want to learn it from your own interest, that's cool. That's fine. Okay.
So in this unit, we only need 2 calculations, do not require 4 calculations.
No. You do entries. I say in 5943, you don't need to worry about what happened after. Yeah. You only need to worry about what happened before. Okay.
Or if we fail this thing in the last year, so if we just do not record any other further transactions, could we just go back to edit the formal transactions and just
No.
calculate it?
No, we can't.
So we have to use reverse double entries to balance it.
That's correct. Yeah.
Get what we lost.
Yes.
What we lost.
Yeah. And there's some of the arguments from people against AASB 2. They said, oh, what happened? They failed these hurdles. Then we overstated our expenses in the past 2 years. right? That's the argument, if they fail. But then the counter argument is that, okay, why do you want to set something up for people to fail? Okay? Your original intention is that you will encourage employees to work harder. In the end, they will get a bonus. That's the original intent. If you're going to set up something for people to fail, why? Okay? And that's why we're going to look at, if you see people going to fail, they're going to modify the contract. Remember, this is a bonding mechanism. Bonding is you want to encourage employees to work harder rather than penalize them for not working hard. Make sense? Okay? Okay, so that's what we said. What is going to happen after if they don't? Well, you just forfeit the equity, forfeit the expenses, forfeit the goods and services you accounted for, provision for, estimated for in the past 2 years. Okay. Now remember, there also a market condition performance vesting criteria. So in that case, what do we do? Remember earlier I told you about how the share options work, and I also told you about the fair value of the share options. The fair value of the share options of today actually already estimate what's going to happen in the future as much as possible. Of course, it's not going to be 100% accurate. So the fair value today is going to incorporate what is the share price growth in the future using the Monte Carlo or also the Black-Scholes model to do those exercises. So therefore, if it's a market condition, then the fair value at grant date is already a solid measurement. You don't need to go and do other estimates. Okay? You don't need to see how likely the share price is going to be in the years before the vesting period concludes. Do you guys understand what I just said? Now, have a look at this example. Okay? So this is a market condition. An employee is granted 1,000 options to buy shares on the condition that they remain employed and the share price is at least $7 at that time. And the fair value of the option now is $10. Okay? So this is our measurement, isn't it? $10 is our measurement. Okay, what's going to happen? Assuming the employee remains in employment for the 3 years, the annual expense will be $3,333. How do we calculate that? 1,000 options, $10 each, 1 over 3 years. So for this executive, you just account for debit employee expense, $3,333, credit equity, $3,333 every year for 3 years. Now, I have a question for you. What is the difference between this question and the last question? Look at the calculation. This is a market-based. This is a non-market-based performance condition. What's the difference between the two in our measurement? We went through a lot of things in example 3. What's the difference? What's the main difference between example 3 and example 4? No, it's still fair value. See, it's still the fair value of the options, $10. Share price $7 is the target. But earnings are the target in the last question, right? In the last example. We know that. Earnings is not a market condition. Share is a market condition. But in terms of our measurements, What is the main difference between the two exercise, the two examples?
Second example, we can know the earning because the earning is the residual of the share price and the option fair value.
That's true. We only need to worry about we don't need to worry about the earnings because that's not a target, correct? Yes, in example 4. But look at the measurements. Look at the measurements. What are the main difference? I just clear out my drawings, but so example 3. It's year 1, year 2, year 3. What are we estimating here in year 2? From at year 1, what are we estimating what's going to happen in year 2? We estimated 2 things. Yeah. Yes. What is the future earnings? And then example 4. Have a look at example 4 carefully. If we are at this point, what are we estimating? Are we? We estimate nothing. We don't estimate how likely the share price will reach $7. We don't estimate in year 3, year 2, again, we don't estimate how likely year 3 is going to reach $7 share price. We don't. But in example 3, we estimate how likely, what is the forecast earnings, right? We don't estimate what is the forecast share price. Why? Because we said it already, fair value of the option and here already reflected the share prices on these days. Does it make sense? So if it's a market condition, full stop, you don't need to estimate how likely the share prices will reach the target. Earnings, however, or other non-market conditions, however, you need to estimate how likely those conditions will be satisfied. Okay, make sense? So yes, of course, in terms of accountants, doing a market-based share-based options is easier for us. Okay. So to sum this up, what have we looked at? We only look at the equity settled share-based payments. Okay. So has the service condition under the arrangement been met? Yes. So are there any performance conditions attached to it? Yes. If no performance, then you only recognize over the vesting period. If it's a non-market based, performance conditions attached to it, recognize over the vesting period if the non-market conditions is expected to be satisfied. However, if it's a market based, you recognize regardless whether you think it's going to be satisfied or not. Again, the reason being, your Black-Scholes model has already estimated what the future share price is going to be. Okay? So if they have not satisfied, simply reverse what you have accumulated in your previous year's recognitions. So, any questions before I go further?
The question about in the last pages, we calculate the is for 3333, but in the option, it's the manager need to pay $10 to buy the share. Am I correct?
No. We don't know what is the exercise price here. Yeah. The $10 is only the fair value of the options. It's not the exercise price, it's not the share price. The exercise price and the share price would not be accounted for in our statements. It's only this will be our measurement basis, because that already reflects the share price and the exercise price.
And so the exercise price is no?
We don't know.
Or don't know?
Yeah. Look, would that make sense? If you set the exercise price at $10, but you estimate the share is going to 7, it doesn't make sense.
You have the power to buy a share in a confirmed price.
If the employee has earned those share options, those employees can exercise their options anytime they want. But to make economic sense, I will exercise my options when the share prices are higher than my exercise price. Yeah?
Yeah, but now we don't know the exercise.
No, we don't know.
So if there is exercise price, what will happen?
Okay, you guys are very, very concerned about what happened in the future. The WSP2 only concerns everything before the vesting condition comes. I'm happy to answer that question. In this case, you will see your fair value options $10 is greater than your share option, greater than your share price. Doesn't make sense. In reality, is this CEO, if he or she satisfies the conditions, getting a lot with the share options, there may be still another condition attached to it, saying you are not allowed to exercise your options for how many years, okay? Or when the CEO sees, okay, the exercise price, for example, is $8, for example, but I only need to get the share price at $7. So at the time, this option is useless to me, yeah? This option is useless to me. Are you guys following? So if the exercise price is $8, but at the time, share price $7, it's useless to me. But the CEO has the choice to hold on to the options, not exercising. For example, if the option has 10 years time, then the CEO going, okay, I'm going to push through the performance, okay, maybe in 10 years time, the share price will go up to $70. $70 with an $8 exercise price, what is the net gain? $62, okay? So you have the right to hold on to the options, not to exercise, until the share price has gone up to a point that you're happy. Okay? In this case, we do not know what the exercise price is.
So this means that the $7 is just for internal price, for like the internal companies can buy the price, but fair value is for external.
No.
Market price.
No, sure, the $7 is the market price, it's the external price.
What I hear is fair value of the options. Right there is $10.
Okay. Options,
If the $7 is for the market value, but there is another fair value for $10.
yeah.
So does that make sense?
Yes, it makes perfect sense. Because this option may have a life of 20 years, 10 years.
Yeah.
In 10 years, the share price will have gone up to $70. That's what they
So
predict.
the fair value will also be changed, right?
Fair value at grant date.
Oh.
If the options freely traded, yes, they will go up in value as well. But a lot of these share-based payments not allow the CEOs to trade their options. They're not freely traded.
If the share, the fair value of granted will not never change, because at the beginning of the
Yep.
time,
Yep.
so if the share price exceeds the granted, it means this company is running good. But if it's lower, like $7, it's lower than $10, it means it's just failed.
Yeah.
For the exercise price, it means that it just sat there. It must be lower than the fair value, because I think company will not still be enough to.
No, I gave you an example earlier on.
But who will buy no, I mean, if the company goes well, maybe some people will buy the share excess fair value of the granted.
Yeah,
But
that's
for
possible.
most of the people, they're willing to buy the price lower than the granted, because they're not still enough to invest money over the
Yeah, yeah,
granted, right?
yeah.
So if the share price keeping going up, it means that people who are willing to invest, maybe they will invest money over the granted, but I think most people are seeking to have, when they buy shares, it's lower than the granted. And okay, so forget about the fair value one. I just want to know that the exercise price will compare to the share price, right?
Yeah.
And if the exercise price is lower than the share price, people are willing to invest. But
No, we will not. It's worthless. If the exercise price is higher, did you say higher or lower the share price?
lower.
Oh, sorry. Yeah, people win. Sorry,
Yeah,
my apology.
Because share exercise price means an options. You can buy in exercise price and you can buy in share price. So
Oh, yes, you
Yes,
guess.
yeah,
Yes.
yes. I think you do stocks. Yeah, so I think the exercise price is just provide internal. It's not
Correct, yeah,
provide for
yeah,
the market.
yeah, yeah.
Because sometimes you will issues at a very low price.
Yeah.
Or satisfy your like long-term or your shareholder stakeholders.
Yeah.
And if this is just options for internal employees or something relatives.
Correct. Correct.
Yeah, so you're willing to buy the exercise price is lower than the share price. If the share price is lower than the auction, the exercise price, no one willing to buy. It's just for future.
Yep. Correct.
Just for future.
Correct. Very good. Yep. That's exactly what it is. Yeah, for future. Yes. Okay. What if things change? Okay. Now remember, the intention of share-based payments is to keep the incentive alive. You want to motivate the employees to work hard, right? But if you see, well, the performance target is not likely going to be achieved, okay, and then you sort of expect the employees are going to slack off instead, right? If you set a hurdle too high, I know I'm not going to achieve that. I may as well just do my minimum job, do my minimum effort. But at that point, the company thinks, okay, I understand the market condition is very bad right now, and in order to motivate the employees, I need to adjust my expectations. I need to adjust the performance targets. Lower, revise it lower. Okay? That's the intention. So what will happen if that happens, right? An entity might modify a share-based payment before it vests. This may occur because share price of the equity instrument has fallen below the exercise price, that it's unlikely that they will ever be exercised. Imagine if the exercise price is too high, then the employee thinks, oh, it's worthless to me. Why should I work hard for something is worthless to me? Okay, that will be the effect. Now, if that happens, an entity will modify the equity set of share-based payments But it must recognize the cost of the original agreement as if have not been modified. If the modification increases the fair value of the incremental fair value, that this must be recognized over the modified vesting period. So what do the last two paragraphs mean? You can make a modification, but the original agreement will be accounted for as before. You're not going to affect the accounting of the original agreement. But at the time of the modification, if the benefit to the employee increases, then you need to recognize the benefit. But if the benefit to the employee decreases, in accounting, we ignore it. Okay? We only recognize the incremental benefit. So I have a diagram on the next page anyway. So what it means is I have a 3-year period. Okay? At this point, I do the modification. And if this modification increase employee benefits, then the increment will be amortized over the remaining 2 years period. You don't touch this part. Okay? What if this modification lower the employee benefits? The standard says ignore, because you don't touch this part. You don't go and modify a decrement adjustment. You only recognize the increment adjustment. Why? Again, they're trying to capture the opportunistic behaviors. Okay? So if you allow them to account for the decrement, they can go and modify these agreements anytime they want. So now firms need to think long and hard. Why do I need to modify? Okay, so they want to make sure the modification has genuine interests for the employees. Okay, so let's have a look at an example of repricing of options, and that is a modification example. What's happening here? We have an original agreement, as usual. Okay, it looks like the only vesting condition is the service period. We have 50 employees. They need to stay with the company for 3 years. Fair value at grant date is 15. Now, at the end of year 1, we expect that 39 people will remain. At the end of year 2, we expect 38 people will remain. And at the end of year 3, the total people remain is 39. You following so far, guys? Okay. Now, this starts from 1st of July, 2000X3. On 1st of July, 2000X4, this is the beginning of the second year. Is that right? At the beginning of the second year, the company decides to lower the exercise price of the options due to a significant fall in the share price since the options were issued. So this may be because the COVID hit, okay? Or something major happened, .com, something major happened, affects the entire share market or GFC. So they will do a modification. At this time, the fair value of the option before taking into account the change in exercise price is to be $5. So the original agreement, the fair value of the options, if they are freely traded in the markets, is no longer worth 15, but 5. Do we touch that? No, we don't, because it mandates its fair value at grant date, not the fair value at measurement date, not the fair value at reporting date, not the fair value at future date. Make sense? So even though it's worth $5, we're not going to touch that. right, so they lowered the exercise price. We don't know how much is it. Anyway, they gave us a new estimate, $8. Okay, now what is the increment? $3, isn't it? The original was only 5 at this point in time. After they adjust the exercise price, then the fair value of the options increased to $8. So there's an incremental benefit to the employees of $3 per option. According to the standard, the incremental benefit needs to be recognized over the remaining vesting period. So again, any questions so far? Meaning at this point, they renegotiate with the employees about the bonus contract. Okay? So, as my diagram shows, you're not going to touch the first original agreement. You accounted for as modification never occurred. However, in addition to that, because there is incremental benefit to the employees, the firm is required to account for these incremental benefits to employees over the remaining vesting period. So in this case, 2, yeah, because the modifications occurs on the beginning of second year. So 2 more years to go before they finish the vesting period. So therefore, this $3 will be amortized over what? 1/2 when you're at the end of second year, right? Don't forget, we still need to estimate the people will remain with the company. So, what is this one doing?
Year 1 we haven't do the calculation the option, so it's same as the last option.
Good. Year 1, nothing has happened just yet. So we are accounting for the original agreement. We adjust the number of people will remain with the company. What happened in year 2? What is this equation doing?
Calculation the original option. It's depend on 15 fair value and the 2 divided 3 years.
Yes. This is, again, accounts for the original agreement. We're not touching the original agreement. We account for it as usual. But in addition to that, we account for the incremental benefit. So we have already worked out the increment value is 3. You guys understand 1/2 here, yeah? Because it's the first year of the 2 years remaining period. So therefore, now the total expenses to company is more than 18,500. Okay? Because you need to add the additional benefit to your original agreement. Now that has jacked up the cost to the company to 24,000. This is in year 3. Everything finalized. We know 11 people left, so 39 people were entitled to these share options. And the 15, the first part, is the original agreement. The 3 is the modification, so the 2 add up to 18. I just dropped the 3/3 and 2/2 part. Do you guys see that? Just mathematically, I dropped this is 15 will be 3/3, right? The 3 will be 2/2. So they are all end up as 1. So I drop that in my calculation. Okay, so this table sums up the calculations and measurements. The first line is the original agreement. Same here. That's if we would split into 2 lines, it will be 15 plus 3. Original agreement. And in addition to the original agreement, year 2 and year 3, we need to account for the increment benefits. Okay, let's take a 10 minutes break. And I know there's a lot of things going on here. So if you feel confused, you have any questions, please feel free to ask. Okay, first, for your employee benefits question, the financial year is 1st Jan to 31st of December. So if you bring up the question,
This one.
yeah, see sorry, can we blow it up? So the financial year is 1st Jan to 31st of December. But this is only 1st of July. So she only worked for the company for half a year. So you need to.
Oh, she only works for the company for half year.
Yeah. So she didn't accrue 20 days. She only accrued 10 days.
10 days. Like the financial year will start from January 1.
Yeah.
But it's July, so it's just accrue if 10 days.
So 19 plus 10 minus
19
20.
plus 10, 20, 9 days. So it's 9.
Yeah. Try that.
Should be this one. Oh, because but here that in Australia the financial year will start from July, right?
Paying out. What is this? Yeah, in this case, this company is a financial year from 1st Jan to 31st of December.
How can we know that?
So it says that the payout 31st of December.
So it's just to spend a half year.
Yeah. Doesn't matter what the financial year is. It says on 1st of July 2022, she has 19 days accrual. Okay?
And if she work a half year, it will be increased 10 days.
Yeah, exactly. So that the 19 days already included the 10 days she has accrued in the first half year.
Oh, got it. That's it. Alright. And about this one, I'm confused about. I'm confused about why that. Oh yeah, this one. Why the share price decrease, but the fair value of option increase?
No, they lower the exercise price, not the share price. They can't control the share price.
Oh, that means that they will in last question it's $7, and this question is from $8 to $5. It's below.
Again, this is the fair value of the options. The $7 you refer to is the share price. fair value of the options and share prices are very different concepts.
Yes, for this one.
Go up, up, up.
Go up.
Oh, no, sorry, down.
Go down.
Down. Keep going. Market condition. Keep going. Keep
For
going.
this one.
Keep going. Keep going. Keep going. Keep going. This one. This one.
Oh, yes. One.
See, share price is not the fair value of the share options. Two very different concepts.
This one, the fair value of the option is 10.
Yeah.
But on this question, it's 12. No, it's 15.
Correct. Yeah.
So this change what? Change the fair value get date? This change what?
Yeah, they changed the fair value. Yes, they changed the fair value.
But it's 15. Why now it's 8 and 5?
No. This is worth $15 at grant date. But at this point, they re-estimate the fair value is only worth $5. And these options, if they stay as the same, they're useless to the employees. Imagine if they're useless to the employees is not going to care. So what they did is to lower the exercise price. Once they lower the exercise price, then the fair value of the options will increase. So they re-estimate the fair value of the options with a new lower exercise price, going to be $8.
So the employee will earn more.
Yeah.
But if we calculate 15 and 5, they will earn 10.
Not five, not 3. 15 and 3.
They will earn 3 more because it's overestimate.
The new estimate has increased.
Increase.
Yeah.
Got it. Thank you so much.
You're welcome.
I'll just ask, what does it mean when it says that the market condition is reflected in the...
What, as I said before, when you look at the fair value of the options, okay, the fair value option is already thinking, what is the share price here in year 1? What is the share price in year 2? Okay, so the option works is you have a share price at the time of exercise, and you have an exercise price. This is fixed. And then the difference is your net gain, right? Then these two will determine what is the fair value of the options.
So it just means that the fair value just keeps changing.
Yeah,
whenever the share
because the
price
share prices will change, even though your exercise price is fixed. However, we need to come to measurement about what is the fair value of the options at this point in time, because we do not know what's going to happen in the future. In accounting, we must account for this. So what the calculation of the fair value of these options take into account what is going to be, what is going to be, what is going to be. They use very complex mathematical models to come to a conclusion. That's the fair value of the options, okay? Is it going to be accurate? No. But that's what we have accepted so far. The measurement of fair value of the options at grant date have not gone beyond Monte Carlo or Black-Scholes models so far.
Yeah.
Yeah.
Okay, thank you.
You're
the other
welcome.
thing I wanted to answer is, so if the equity instruments end up, this is for the non-market, if they end up not vesting, you just reverse the amounts. What if, for example, in year 1 you think they're going to vest, and then in year 2 you're like, oh, okay, I don't think they're going to vest at all. Then does that mean that in year 2 you just reverse everything you did in year 1?
Yes, yes,
Okay.
yeah. But that think about it logically. If they think that's not going to happen in year 3, they may need to readjust the earnings
Yes.
estimate. Yeah.
And then you need to account for that as well, the adjustment. Yeah. Okay. Yep. Thank you so much.
You're welcome. What's your name? You just came back from overseas? Okay. Have you studied this course at all when you're overseas?
I started this course.
Today? Huh?
I come back to Sydney.
Yeah. You have a lot to catch up on, don't you?
No.
Huh?
Teacher, can you speak again?
Okay. Maybe Shen. Is it Shen? Shen, come, please. So you two, you have in a team. You two going to be in one team, okay? Okay. I don't know about your situation. You mean? Yeah. You mean?
I can't come back to Sydney this week.
Now I'm a bit concerned because you're very behind, and this is a teamwork. You both need to put in the effort equally. Do you understand? Yeah. So I don't want any one of the members going to be disadvantaged. Yeah, both of we need to put in the effort equally, yeah? Okay, so if you're very behind of what we are doing, then it's not fair on Sven. Do you understand? Do you understand what I just said? Yeah. Okay, why don't you two email me after the class? Email me, you can exchange contact details and email me, then I will email you a firm. How's that? Firm choice. Now, at any point, if any one of you feeling very uncomfortable because the other member is not doing their jobs, please get in contact with me. Okay? So haven't got many days left. You only got 1 week to finish the report. Do you understand? Because the report is due next week, yeah? And you two haven't started. Do you understand? Yeah, but the reason I can't put you into other teams because it's you started so late. It's not fair on the other teams. The other teams is already organized and already start writing the report, start doing the report. So if I add you on to the existing teams, anyway, there are no existing teams less than 5 people. That's the first reason. Second is it's not fair on the other teams if they have already started and you two just join. Do you know what is going on?
Other team have started.
Do you know what the requirements are? Yeah, okay.
Find a company about its ESG.
Okay. Yeah, but need to email me first, then I'll email you a firm choice. Make sense? And why did you come late today? We told you. You emailed me saying you're going to come to the class today. Why did you come so late? Huh? Finding this building.
Yes.
Okay. Have you never been to UNSW before? You have?
Other building.
Oh, you've been to other buildings.
Yes.
But you came in 1 hour later. It doesn't take 1 hour to find where the building is. You were about 1 hour late.
I'm so sorry.
And you coming in with just a handbag. Are you coming in to study? Like, people have the materials in front of them. And what are you coming here for?
Why?
you coming here to study? Or you just come here to meet your teammate?
Yes.
Okay. Anyway, I'll let you two manage each other, but at any point in time, if you feel you've been overloaded, the other person is not doing anything, let me know, okay? Yeah? And email me about your contact details, and I'll give you a firm choice, okay? Okay. Okay, guys. All right. I do need to move on in order to finish the topic. So, it's not going to work. Do you guys okay with what we have gone through so far? Okay. You guys okay with what we have gone through so far with the equity settled SPPs? Yeah, we've gone through quite a number of complex scenarios. First one is simple, just the service period. The second one is with the earnings as a performance condition. And then the next one was a market-based condition. And then we're going through the modifications. Right, so this is the time we go into a cash settle SPPs. Remember, the nature of cash settle SPPs is we will pay the counterparty cash, but the value of the cash is in reference to the value of the equity instruments. And because the transaction involves cash outflows from the company, therefore, that will result in a liability before the cash payment is paid out to the employees, right? So far, you guys okay with that? Now, however, for the cash settle SPPs, you will see the measurements are very different, right? So it says it's one where the entity acquires goods or services by incurring liabilities based on the value of the shares. Under such transactions, the fair value of the liability involved must be measured at each reporting date. And the changes in the fair value are recognized in P&L for the period. Very simple two paragraphs, but there are many, many things behind these two paragraphs. First, remember, what is the value of the instrument before, under equity settled? What was the measurement basis under equity settled SPPs? That is the fair value at grant date. Remember that? One fixed measurement. But in this case, no. You need to remeasure at each reporting date. Why? Because that will result with the variations in your cash flows. Let me give you a simple illustration. Why this matters? Why you must remeasure at every reporting date rather than at grant date. Soon you will see a share appreciation rights example. Okay, so how this cash settle SPPs work is this. The company says, this is your exercise price. which is $5. Okay? And this is the share price. So at the time they enter into the agreement, the share price is $6. Okay? 1 year later, they satisfy the service condition, for example. The exercise price remains at $5. At this point in time, the share price is $10. What is the settlement? $5 cash to the employee. Can you see that? Okay? So the company will need to pay $5 cash. 2 years later, if this is $20, then the company will need to pay $15 cash. And that's the reason they must remeasure at every reporting date, because the cash payment will be different. Depends on the share price at that time. Okay? It will affect how much cash will flow out of the company. Now, let's not to worry about other future conditions. Let's just assume the fair value is just purely the difference between the share price and the exercise price. So the fair value at this time is $5, right? A very simple calculation. I ignore many other things in the black shoe model. I only look at the difference between share price and the exercise price in order to give a very simple fair value calculation. So the fair value is $5 at this point, right? And the fair value at this point is $15. Can you see that? What is the difference? Come on, guys. $10. Okay? If the number of employees have not changed, would the liability go up or down? From year 1 to year 2, if the number of employees have not changed, would my liability go up or go down? Come on, a very simple question. Will go up, correct. And what is the difference of liability? We'll put it through P&L, okay? So do you appreciate what is going on between these two paragraphs? So going back to our first example, our expense changes because the number of employees change, right? Do you recall, guys? Now, if it is coming to the cash settle, your expense not only change because of the number of employees, your expense will change also because the change in the fair value of your options. Two things happening at the same time. And these two changes all must go through your P&L. Make sense? Are you following, guys? We will see. Okay, let's look at this example, and you will see what I mean. Okay, there are changes, not just the number of employees. There's also change brought about by the changes in fair values. Okay? So this is called the share appreciation right. So as soon as you see share appreciation rights in your exam or major quiz, whatever, you know this is other cash settled SPPs. And therefore, they must coming through from your cash. Therefore, they must be recognized as liabilities. Okay? How do they work? So at the beginning, they have 100 SARs to each of its 50 employees. It's conditional on they remain with the company for next 3 years. So thank God for that. That's only service condition. We don't need to estimate anything further. And the intrinsic value, estimate of the fair value of the SARs at the end of each year are as follows. Why? Because they must be remeasure based on the fair value at the reporting date, not just the grant date. So we need this information. Secondly, what is the intrinsic value? Cash payout. So in this case, $5, right? In this case, it's $15. So the intrinsic value is the difference between the fair value of the shares to which the employees has the right to receive and the price that they would have to pay for those shares. That means what? The difference between the exercise price and the share price at the time they exercise. In this case, they're not going to the market to exercise. They simply present to the company. Now the share price is this much. This is my exercise price. You pay me the cash, the difference in cash. Okay? Make sense? That's better. Why? So there's no transaction fee for the employees. The employee simply goes up to the company. That's what I want to exercise. You pay me in cash. So I don't need to pay commission fees to the market agents and whatsoever. So the intrinsic value represents what? Cash payout from the companies, cash outflows from the company to the employees. Okay. So obviously, some of the employees exercise at the end of year 3. Some employees exercise in year 5. Some of employees exercise in year 6. So you will ask me, why do I still need the fair value in year 4? The service period is only 3 years. Why do we still need the fair value in year 4? I'll give you the answer. Why? For the people have not exercised at the end of year 3, the company still owes them liabilities, right? And these liabilities still need to be remeasured at reporting date. Do you follow me, guys? If at the end of year 6, still people remain, they have not exercised, we still need the data. Okay. That's what it means. The two changes affect the liability values to the company. One is the number of employees remain, another one is the change in fair values of these options. Okay, so the first table is very simple as usual. 9 people left, 41 will remain, 40 will remain. This is 41 will remain, okay? Actually, 41 remained. We okay with this table? Second, at the end of year 4, 15 exercised. At the end of year 4, 14 exercised. At the end of year 5, 12 exercised. Now, guys, for the employees that have exercised, would the company owe them anything? Would not. 41 people remain. We clear on this one. 41 people actually remained at year 3. At the end of year 3, also 15 people exercised. 41 minus 15 is how many? 26. Are you guys following me? So at the end of the year 3, the company only owes 26 people money. Okay? At the end of year 5, no, at the end of year 4, the company only owes 12 people liabilities. Do you get it? Would these liabilities need to be remeasured? Yes, they need to be remeasured. They need to be remeasured using this value. So whatever liabilities owing to these 12 people at the end of year 4, we need to remeasure using the $21.40. Okay? Sure.
Does it mean that every time the share price changes over the ACCT price, we need to do the steps for the
Yes.
even $1?
Exactly. Yes. 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 Correct. So there's actually a lot of work involved by the company. They need to remeasure the fair value of the options every year. But you just saw the ACIS report, right? I showed at the beginning today. A lot of cash-related bonuses. That is actually a major part of the CEO compensations these days.
What about each time the share price change, right?
Mm.
Like at end of 4, it means 50% has exercised in the beginning of 26.
Mm.
But after we value the share price, maybe there is one share, maybe the share price increased $1. They are in relation to the former 50%.
No, because they already exercised.
So it means just the people only exercise once
Mm.
for exercise price,
Yeah.
and later it just depends on the share price.
Yeah.
Okay.
Okay, let's see what's happening here. Year 1, as usual, but look at the measurement basis. It's the fair value at the end of the reporting date, not the fair value at grant date. Okay, what was the fair value at grant date? See whether they have said anything about the fair value at grant date. They didn't. Okay, year 2, look at that. This is recognized as a liability rather than an equity. Year 2, again, similar, same thing, but the measurement basis has changed, been updated. Okay? Now, you can go and do an exercise. I want you guys to do an exercise for me now. Let's say remains at 9. In year 2, the estimate has not changed. That remains at 9. Would that be increase in liability? My quick answer to that, yes. Why?
Because one person.
No, if we remain 9,
Yeah.
let's recalculate this.
It's 41.
Hmm?
I mean, if you change 29, right?
No. What I mean was, last year was 9 people, right? We estimate 9 people. Where did it go? Yeah. First year, we estimate 9 people. What about the second year? These 9 people have not changed. We recalculate this, replace 10 with 9.
You replace it with 29, right?
Yeah.
This means that one person is included. Because 50 minus 10 is 40.
41, yeah.
Minus 9 is 41.
No, what my question is, will second year's expense increase? Why? No. Ignore this, ignore 10. Yes. Let's ignore this. Let's say they always stay at 9. Okay? Would the company's expense change if they always remain at 9? The answer, according to this table, is yes. In what way? Always go up. Why is it going up? You can see the fair value has gone up every year. That's why even the employee number has not changed, you still need to recognize the additional liabilities into your P&L due to the changes in the fair value. Okay? So in second year, we re-estimate the number of employees remain, but use the new fair value that's amortizing over 3 years. In year 3, listen carefully. What happened in year 3? This is finalized, yeah? 9 people remain, we know. But some people exercised, 15 people exercised. So this will be the payout. the cash payment to these 15 people is 15 times 100 times 15. That's the cash payout. That's easy to calculate. But at the end of the day, we owe 26 people still, right? And these 26 people will need to be remeasured at $18.20. Do you guys understand? Good. Okay. So this is what's happening. They pay out cash for these 15 people. But at the same time, we need to remeasure our liabilities owing to the remaining 26 people. Why 26? 9, 15, 24, 50 minus 24, 26. Okay, are you guys okay so far? We need to remeasure. What are we measuring here? Yep, the total liabilities owing to the last people, correct. Okay? So the increase in liability is 5987, we know. And how much is our current year's expense? Okay? Our current year's expense increased by 28,487. Now, up to this point, our double entry accounting is very, very handy. Why is handy? Because I know we pay our cash, which is a credit account, 20,500. And from this last calculation, we know our liabilities has increased by 5,987. There's also a credit liability, 5,987. And the balancing number will be 28,487. That's why our expenses has increased by 28,487, not just 5,987. Do you guys see that? Okay. That's okay for year 3. Now in year 4, do we expect our liabilities will go down? Because more people exercise now? Not necessarily. If the fair value has gone up so much, then we may still owe more liabilities to the remaining 12 people. Make sense? But we'll have a look, see whether that's the case. All right, so in year 4, 14 people exercised, so we need to pay them our cash, $28,000. The remaining 12 people, how much we owe them? Okay, $21.40. Now at this point, we actually has decreased our liability. We're slowly discharging our liabilities now. Okay, this is what the total liabilities we have recognized in the last year. At this point, our liability will go down by 21,640. Okay, so why do we still have an expense? I thought at this point, the number of people we may have decreased so much. Why do we still have an expense? Because that comes out from the what? Change in fair values. That comes out from the changes in fair value. The fair values has increased. Are you guys okay now? See, this is no longer a credit entry, but debit entry. Why debit? We have discharged our liabilities by those 14 people. By those 14 people exercised their rights. Okay, at the end of year 3, the remaining 12, at the end of year 5, I think, 3, 4, 5, yeah, at the end of year 5, the remaining people exercised. Okay? Do we owe any more liabilities? No. There will be no liabilities. The remaining liabilities will be debit. Okay? We clear out our outstanding liabilities. And the difference between your debit account and credit account is our current year's expense. So what do you see from this exercise? For cash settled SBPs, your measurements do not stop when the contract has concluded. Okay? It will stop only after all people have exercised their rights. So this will cost the company a lot more. And also, we need to remeasure those instruments at every reporting day. Of course, the fair value may go down one year, or may go up another year. Okay? And that will create more volatility to your earnings due to the changes in fair values in comparison with the equity settled SBPs. Does it make sense? Okay. So sums up, what was happening in the last 5 years? Okay, in the first 3 years, in the first 3 lines, we recognize how much these share-based payments are going to cost the company. And this recognizes the cash payments. Okay, in the end, I think the T account our accountants use is very helpful. The liability at the end of year 4 is 25,680. But in year 5, everyone has exercised. Therefore, we owe no liabilities anymore. But we'll pay out 30,000 cash. The difference will be our residual that will go into our P&L accounts. So, to sum it up, the difference between your cash payments and the increase or decrease in your liability owing will be settled through P&L according to this standard. So I really want you guys to be very comfortable about calculating these things. It definitely will be, everything we go through today definitely going to be in your major quiz, or may even be your final exam.
So it means that at the end of 6 years, it means the company has already paid back all the investors, and investors get the money from the company.
Yes.
So it's all balanced. It's equal to 0 at the end of year 6.
Yes, correct.
So it means that the expense of the recruiting is by, for the end of the year is using the formal 3 years minus the 2164 at the relative value, because we want to balance it, because the company has already paid back for the investors' money.
That's correct, yeah.
So only the money is like controlled by company is within the 6 years, but after it is going to be there.
Yeah, that's correct, yeah. That will conclude, correct.
So the first 3 years vesting years is owned by the people who bought their shares, and the last 3 years is the last 2 years means the company, or also the 4 years is included by the company to pay back those shares, right?
Yeah. Not the people bought the shares, the people signed the contract, yeah. Company signed the contract with, yeah. Okay. Now I'm running out of time, but I still want to go through a couple of practice questions with you guys, just to make sure that you're comfortable with the concepts, okay? Of course, we can't go without our ESG reporting these days, okay? So Let's look at what's happening with the SP payment in action. Right, this is a report from Deloitte, 2022, which is about 2 years ago, or a year a bit, okay? So, what did they find? They found a lot of common errors and oversights, okay? So they focus on the long-term incentives on SBPs, and they acknowledge it's very common now, not just to senior executives, even for like entry-level employees. What are the common errors? First is the option valuations, particularly for those employee options, because they are not freely traded in the market. It's all internal. So that's a big audit risk area, okay? And the auditors often argue with them, how do you calculate, how do you come up with the fair value of the options? And at the vesting conditions to be decided to the deciding accounting standards, policies, especially change-based vestings. Meaning the vesting conditions also are gray area because they will affect how the firms amortize the employee expenses. Okay? And how do they estimate whether the employee is going to meet or not going to meet those vesting conditions, like the performance attached, non-market performance conditions, right? Those areas really requires auditors and accountants exercise a very high level of professional judgments. And the modifications to existing share-based payments. A lot of firms fail to account for the increments. So this is what's happening in real life.